What's up, guys? This is video number 2 in the stocks and stock market series. You could access this series if you go to the main page and you click the IGTV symbol, and it's the middle symbol on my page. And then you'll click series and you'll see it there. So all these videos will be uploaded there. So if you ever need to come back and refresh yourself, or if you have a friend or family member that's interested and they want to learn all the way from 1 to how many ever end up adding. So to pick up where we left off, we talked about exactly what a stock was last time, right? So this time we're going to try to build on that, and I'm going to teach you guys a couple of ways to evaluate. And these are fundamental ways. The whole goal of this is to give you a good base, a fundamental base, and then from there you're going to go and hopefully grow your wings, and you're going to learn more things, and you're going to learn on your own. But you'll have a basic understanding of how to invest and at least what you're looking at, right? So you don't feel overwhelmed when you do decide to make your first purchase. So after all this, you should feel confident to open a brokerage account. You know, a lot of people use Robinhood. You know, our age, I recommend TD Ameritrade, but hey, whatever works for you, right? So first thing I'm gonna have you guys do is you should download the Seeking Alpha app and the Yahoo Finance app. Seeking Alpha, it's a smaller company, but basically you could follow a company and there's a bunch of people that are writing articles and putting opinions about it. So it always gives you like cutting edge news. You do have to pay for the premium service, but a lot of the time the articles are free and it gives you updates. And then Yahoo Finance is great. It's an easy way just to check on what the heck's going on, right? So those two apps I highly recommend. Both of them, whatever stock you put in to them, like you put in Walmart, you put in Costco, you put in Apple, Google, whatever, right? You're going to see like a snapshot, a financial snapshot. And it'll have stuff like 52-week range, market cap, PE ratio, EPS, which is earnings per share, dividend, and earnings dates, usually, along with a few other things. I think if I explain these to you guys the most, you guys will have a better understanding of what the heck you're looking at, and what those numbers and those everything is saying to you to help you make a decision. Hey, should I buy, should I sell, or should I wait, right? So we're going to start off with market capitalization. So that's what market cap means. So the first thing you see is a market cap. And what a market cap is defined, it's the total dollar market value of the company shares. So it's the total number of shares times the share price is listed at. That's going to be the market cap, right? So if Apple had 1 million shares out there and the shares were hypothetically trading at $1, the market cap for Apple would be at $1 million. So this kind of gives you a size of like how big the company is, you know. So like if you're investing in something small versus something big, it just, people just psychologically like to know that number. It's not hugely important. It's just, you know, it's one of those numbers like, oh wow, like, you know, it helps you determine how big of a share a company might have in a particular sector, right? So if you look at Ford and their market cap's at like 10 billion, and then you go look at General Motors and their market cap's at like 1 billion, you're like, oh wow, like technically Ford would be 10 times bigger hypothetically, right? So it kind of helps you figure that out, but it doesn't mean that one company's more profitable than the other just because the market cap is higher. It's just, like I said, psychologically for you to see what the value of the company is perceived in the market. So next, we have enterprise value, and the enterprise value means, you know, a company is also referred to as like an enterprise. So it's total market cap plus all debt, short and long, you know, and any cash that they have. They look at that like as the actual total value of the company, because one day that debt's going to be paid off, right? And theoretically that debt will become positive because they use that debt in a positive manner to grow the company, right? So that it becomes like an enterprise value. Once again, it's just a metric to help you determine like the size of like the company. So we have earnings per share. This is what we all wanted to get down to. This is what you look at, and this, yeah, PE ratio and EPS, earnings per share, are kind of like the same thing. They need one another to kind of help you determine. So I'm going to keep, you know, I like the constant reminding so that it helps me remember. So market cap is just like how big something is. Think of like if you watch sports, you always hear about, you know, staying under the cap, you know, like in NFL, NBA. So that's like the cap is like how much a team could spend every year. That's how big you are, right? And so for earnings per share, it's just the total profit that the company has made in a particular time. It's usually in a year or in a quarter, divided by the number of shares, and that is a profit per share that you have. So the EPS you see is usually per year, but you know, analysts like to look at it, you know, per quarter. But you'll see like you'll see a stock that says, you know, let's say Apple was hypothetically trading at $100, and the EPS is $1. That means for every share you're buying, you're earning $1. And so that's what the E in PE stands for, is the earnings, right? So it's the total profit divided by the total number of shares, and then that's your earnings per share. And then you have the price, which is, you divide those two to get a PE ratio. And the price is just what the current market price is going for, right? So, you know, what that ratio means, what it comes down to is, you'll say, that's how much you're willing to pay per $1, right? So if a company has a PE of 15, it means that you're willing to pay $15, right, to earn $1 per year, in a sense, broken down. That's why people look at PE, and a higher PE, it means you are paying a premium, right? Because logically speaking, you wouldn't want to pay, a PE of 20, right? You wouldn't want to pay $20 to make a dollar, right? Because that means you're earning like 5%, right? So like if it's like, hey, I give you $20, hey, how about you give me $1 a year, right? So it's theoretically going to take you what, 20 years, right, to make your money back, right? And if the PE is at like 10, then it's like, hey, I'm going to give you $10 right now, but every year you're going to pay me back $1 in a sense, right? And that means you're going to get your money back in 10 years. So you kind of want a lower PE in a sense. But a higher PE doesn't always mean that you're going to get paid back like, shorter. It usually means that us as investors, or the market, investors in general, are saying, wow, we're willing to pay more money, for this company, because we think in the future it's going to make a lot more money than what we're paying now. So you take like Facebook as an example, right? I think Facebook trades at like 23 PE, 23, 24. I've seen highs of like 25, right? But you're willing to pay $25 today to make $1 a year roughly on Facebook, because you feel, or the market feels, that over the course of the next 4, 5, 10 years, whatever time in the future, that Facebook is going to earn you a lot more than $1 a year. You know what I mean? Because once you bought into that price today, in 10 years, that stock price is going to go up and those earnings are going to go up, if that's what you believe. So that's why PE is really like, a quick way to look at something and say, what is it that I'm going to, how much money am I willing to pay today to earn $1 on it? So a lot of people like to use, or Wall Street does, is called TTM, and that's a trailing 12 month. So there's really like two ways to look at it. You have future, what somebody's projected. You can't really trust those numbers. Is what, like, if I was the CEO and I say, hey, I think we're gonna make $3 based on this and that, but if those earnings are off and we only make like $2, that's gonna affect everything, right? So a lot of people use the trailing 12-month average. That means, what has this company earned in the last 12 months? And we're gonna use that, divide that by the price that the stock is currently today, and that would be the PE. Um, and for me, the PE, it's really hard because you're only getting a 1 year look at it, really, right? So, a lot of things could happen. Like, look at COVID, right now, right? You could have 1 or 2, like a whole year where a company did really, really bad. And if the stock, depending on what the stock does, if you divide those earnings by the stock price, the PE is going to be very skewed. So when you're actually investing, what you want to do is look at least 5 to 10 years. That's a good rule. I would say probably 10 years of a company earning profits. And then you get the average, usually of those 10 years profits. And then you can determine how much you think this company's going to grow, right? Then you take that number and divide it by the share price, and you'll get a better understanding of what the price is worth. So let's just take a step back, because I just threw a lot of stuff out there at you, and you might be looking at it like, dude, what the hell? Like, I don't understand any of this, like what it is, like what's going on here. So I want to break this down very simply, and we'll get into a little bit about Schiller and why the PE might be important. Okay, basically, all you need to know is, what market cap is the total number of shares a company has multiplied by the stock price. That's the market cap. Throw that out the window. You know what 52-week range means? It means in 52 weeks in 1 year, what was the lowest it traded, what was the highest it traded. It's just both of those are good psychological things. Now the PE, let's break this bad boy down. To keep it simple, PE would be just earnings, how much earnings a company can make in 1 year, and you divide that by the stock price, and you're going to get, or the stock price divided by the earnings, you'll get the P, which is the price of the stock right now, and E with the total earnings, what it's worth. So when you look at stocks, when you're on your Yahoo Finance app or your your Seeking Alpha app or whatever app you want to use or whatever site you want to use, you'll see a PE of 10, 15, 20, 30. That means whatever number that is, that means that's how much you're willing to pay per $1 of earnings. That's the key thing in all this right here. When you see PE, all you need to know is if the PE is like 20, it means today for that stock, you're willing to pay $20 to earn $1. If the PE is 100, that means you're willing to pay $100 to earn $1. The higher PE, it could mean that the stock is way overvalued, or it means that you believe that the stock is going to be worth more and this company is going to make crazy bucks in the future, and you guys are all dumb for not buying it. Usually in the market, someone's right, someone's wrong. So that's what PE means. And there was so Benjamin Graham, which was Warren Buffett's mentor, and he wrote a book, a couple of books actually. There's an Intelligent Investor, and there's another one called Security Analysis. And Security Analysis is a freaking tough read, so I've heard. I have yet to read it. I have read his first book, The Intelligent Investor, and it just kind of explains how you should diversify and how you should be investing, looking at basically just companies that are more solid, right? And Security Analysis goes into way deeper, and it's even above me right now. I'm sure I could break it down, but I would need a pen and a pad too, right? But there is Schiller came along, and this guy, his name is Schiller, and he made a PE ratio, and he said, we shouldn't just look at 1 year's earnings because it's too volatile. We should look at 5 to 10 years. And basically, he made a Schiller PE ratio, and you could Google it. You could just type in today's PE ratio, Schiller PE ratio, which stands at 26 for the market. It goes for the overall market. So today, I believe the market is high because the Schiller PE is 26. That means you're willing to pay $26 to earn $1. It means that it's going to take you 26 years essentially to get your money back in a sense, right? And that's less than the Schiller PE ratio online. It's less than 1% back on your return. Not really worth it. Now, the average PE ratio has been 15, right? That's been the benchmark like throughout stock trading. On the low end in 1920, it was at 4.78, so around 5. And on the high end, it was 1999. Party Like is 99. It was at 44 PE. It means you were paying $44 to earn $1. So, I still think 26 is extremely high. But then again, you got all kinds of inflation. You got a bunch of stuff going on. I mean, there's a lot more to this, guys, than just these numbers. So these numbers and these concepts right here, and you were reading a PE market cap, these are all just little tools to help you make a bigger decision, which is, do I buy? Do I sell? Do I hold? What the hell do I do? And there's never going to be 100% right answer. But what you need to do is you need to have these tools in order to get the job done, right? So think of you knowing what a market cap is, 52-week ranges now, knowing what a PE is and what it means. It's like I just showed you how to use a hammer and a nail, and there's a bunch of things you could do with the hammer and a nail, right? You can nail wood, you could take nails out, you could do a bunch of stuff with it. But at the end of the day, it's still up to you to build something. It's still up to you to do something, right? So this is one of the many tools that's out there to help you determine what it is. And everyone's going to have their own way in life and like what they deem, what they want to invest in, what their risk tolerance is. So you need to figure that out yourself. But I hope that you got a better understanding of what a PE is and what market cap is and what 52-week range is. Remember, PE, when you see that number, it is how much, so if the PE is 10, it means you're willing to pay $10 to make $1. If it's 20, it means you're willing to pay $20 to make $1. In the long term, the average has been 15. On the high end, it's been, above 30, the highest has been is 44. The lowest has been is 5 over the course of now close to 100 freaking years, right? So guys, this is a breakdown. I know this is really like a lot. I mean, if you don't know what the heck was going on, but I hope you learned something from it. I hope you had an understanding of what a PE is now and kind of how to get it. If you didn't, please drop a comment. If you need to, if you feel embarrassed, you could drop me a DM and I will try to re-explain it in a different way and hopefully make it better. But I think you understand the basic concept now of what EPS, like what earnings per share are, how to get those, and what a PE ratio is, and along with market cap and everything like that. So, hey, if you like the video, give it a thumbs up and tag somebody in the comments or DM this to a friend and help me grow the channel.